Hello and a very warm welcome to everyone from CRED. We are very excited to bring to you a series of finance webinars every Saturday featuring an expert and thought leader in the space of taxation, investments, and all things money. In today's session, we answer if our savings dictate our investments or is it the other way around. If you've been investing without a structured approach, today's session will help you understand mutual funds better and how they can help structure your finances. For the session, we have with us Srinivas Jain, Executive Director and Chief of Strategy at SBI Fund Management, who has over 22 years of asset management expertise to his credit. You can post your questions in the chat section, and Srinivas will be answering them towards the end of the session. Over to you, Srinivas.
Thank you very much, Ankita. Thank you for giving me this opportunity to talk about how to plan your financial future with mutual funds. And I'm going to primarily talk about how mutual funds can help you do that. I also plan to touch upon basics of savings, investing, and how can one use mutual funds to achieve both medium-term, long-term, and of course, short-term goals. The idea also is to make a point on why savings and investment is so very important to us. Basically, historically, we've seen that savings have been, without much of a design or planning, and as you talked about earlier. One of the objectives of this talk is to actually give you very basics understanding of how you can make those choices and how you can make those choices, especially keeping in your life goals into consideration. And more importantly, specific to mutual funds and how mutual funds can actually help you design and manage those goals. So let me try and share my presentation here with you. Just give me a second. Okay. I hope my presentation is visible to everyone. Before I actually jump in and talk about my presentation, I actually want to talk about the topicality of what's happening around us. If you start looking around, what's really happening is that we are in this scenario of COVID-19 pandemic, which has basically exposed all of us on how financially underprepared we were across the country. There have been job losses, there have been very high medical expenses people are not able to meet. These are becoming a huge issues. One of the big lessons that we've learned is savings actually is a good thing, but really savings is not enough. You really need to manage your savings a little better. One of the things that's really happening is that there is the higher standards of living actually is a mismatch towards the kind of expenses and the income that we are generating. So basically, what's important is how do you manage your income, and through that income, how do you manage your savings? And through savings, how do you optimize your investments? And that's a very critical piece that I want to talk about today. One other interesting fact that we tend to miss in our conversation around savings and money is how important inflation is. Historically, inflation has been eating away into the return expectations or returns from our investments or a growth of our investments. And today we need to understand how inflation affects your savings and what we need to do to protect ourselves from eroding our savings in the long run. Also, what is really important is how do you financially secure your future in a situation like now? How do you financially make your future better, especially in the current COVID financial emergency that's around us? So, before I move to the next slide, I want to talk a little bit about how investing long-term is so very important for us. In fact, in this slide, historically, we've been a country of savers. We've been saving quite aggressively, one of the best nations to save. But our savings have been very much around investment avenues such as contractual saving rates like bank deposits or PPF or employee provident fund, national saving certificates, recurring deposits, fixed deposits of companies. Because our orientation has been around how do I kind of get a particular rate of interest which can cover my future requirement. Now, these are actually over a period of time have seen as a suboptimal return for two reasons. One, of course, is they are sometimes illiquid, but most of the time they're not able to meet inflation expectations. So beating the inflation is becoming a very important trend in saving money, and through saving money, how do we create wealth? So the main objective of my talk is how do I get wealth creation and create long-term financial freedom by investing across multiple asset category. One of the important asset categories, equity. I'm going to talk a little bit about equity as part of this talk. So here is a very interesting slide, right? I think this has been talked about in the past for people who don't understand. Basically, when you invest in a contractual saving like a fixed deposit or a PPF, of course, PPF interests do vary, but they are usually static and they are usually around 7-8% kind of return. So here is another interesting example. If you were to have invested 10 lakhs of rupees in not very far away in 2016, 5 years ago, in 2021, that 10 lakhs of rupees in a fixed deposit would have fetched you about 14 lakhs of rupees. Just give a hypothetical example of 7%. Similarly, a public provident fund would have fetched you a little higher at around 14.51%, right? That's the rate in which you got in the last 5 years. Now, I'm not talking mutual fund, just simply investing into a broad index like a BSE Sensex, which has about 30 stocks, would have fetched a return of 14.3%. And just see even in 5 years, the return is almost 50 lakhs rupees more than what you would have got. In 5 years' time, this 10 lakh of rupees would have grown to 19.50 lakhs, which is, after expenses could have been a little lower, but still in the ballpark of 19 plus lakhs of rupees, which is a significant, uptake that you get. So equity markets technically have almost doubled in the last 5 years. At the same point of time, what's really important to know is inflation is kind of eating away. The last inflation has moved from 4.83 to 5.45 in March. Basically, if you were to take an average of even 5% for the last 5 years, which is actually moderate, your actual return on a fixed deposit would have been only about 2% because adjusted to the money value today. At the same time, investing in equity could have given you a return of almost 9% plus, right? And of course, there is an angle of tax and all of that stuff, and I don't want to get into it. But post-tax, post-inflation, investing in long-term, investing in equity definitely has some benefits around it. So, let me take some, understanding of why while we are building this investment, what's important is actually the financial plan, right? The financial plan, creating a financial plan is so very important because most of us do tend to save, either in deposits, contractual saving. If you're a salaried employee, your PPF gets deducted. Excellent, because you don't have to do that extra effort. But what really happens there is that you really don't know what you're saving for. It's just saving that's happening. So basically sitting down with a financial planner or yourself and writing down the financial needs that you have, both that are expected and unexpected, is very, very important. Right? So one of the things that we keep saying is that take a piece of paper, write down your near-term goals and long-term goals, right? Put the period around what are the near-term goals and long-term goals. And once you start writing it down, your plan becomes even more, how do I say, in your head, you try to understand what it takes to make up for those long-term goals and near-term goals. This will kind of lead to a little more less stress because now you know that these are the goals and then what do you need to do with it. And once you understand what are these goals and what you need to do with it is how you will actually in the long run run towards a financial freedom or a financially efficient investment goals. Now let's talk about what is a good financial plan, right? And a good financial plan is actually very key to meeting all your financial needs as an individual. So first is to identify the goal. What are you saving for? Most of the time, these goals are well known, right? It's either a retirement or some medical expenses, education for your children, buying an asset like a gadget, financial planning, vacation planning, more importantly, something like a house, which are all common need for us to save. So setting the target amount for each goal and the period for which you want to achieve. Basically, the longer the goal, like a retirement goal, is a longer tenor goal that you need to look at. In the investment universe, there are about 3 or 4 three variables in how you look at what is your investment goals. Any goal which is between 1 month to about 3 years is seen as a short-term goal, right? It could be 0 day to 3 years, but it's seen as a short-term goal. Anything beyond 3 years to 5 years is your medium-term goals, and anything beyond 5 years is seen as a 5-year goal, as a long-term goal. The reason I say this is because you are most important while we're doing this is to look at asset allocation. The next slide actually talk about what are these asset allocations and how does it help. We all know what are assets. I talked about equity. Investing in equity markets is an asset. Investing in a fixed deposit or investing in a bond is an asset. Investing in a real estate is an asset. Investing in gold is an asset. So these are different assets. How do you invest this? What is the right optimum mix that you want to invest is the most critical thing. And while doing this, how do you overall bring your risk down is the most important aspect to look at. What is important is over a period of time, different asset classes, whether it's deposits, whether it's which is interest rate product, whether it's gold, whether it's equity, or even bonds, have done differently in different points of time. And I have a slide about it, which I will talk later. One of the important things is what kind of asset allocation you can have, which can actually beat inflation. Equity is actually a very important tool in long-term wealth creation because equity has been seen as a tendency to generate better return than inflation. In fact, inflation beating return, we say. At the same point of time, equity is very volatile, right? So point-to-point returns in equity may be very high or very low, depending on what point you get in or what point you get out, right? At the same point of time, fixed income or products like debt funds actually generate relatively low risk. Of course, depends on what kind of fixed income products that you buy. Relatively low risk, but their investment or return potentials are relatively low. Gold is also a very interesting, asset class. Of course, in India, we bought gold largely as an ornament, but it's a very important hedge against things like risk of inflation or currency devaluation or like war and famine. These are assets which actually does very well. So I want to talk a little bit about how long-term investing is very essential before I talk about how of these asset classes have done very well. So anecdotally, people have seen that we are good at managing short-term finances than long-term finances. Long-term finances are very hard, even though it's the most easiest thing to do, are very hard because this requires really long-term financial discipline. And I'm going to talk a little bit about later on how this can be done very easily through mutual funds. But long-term financial planning is actually very essential as value of the money gets eroded over time. We don't see that. Money is staying in your savings bank for a very long period of time actually is not the same money that you have because savings bank interest rates are very low. In the long run, those interest rates are not even beating inflation. So ultimately, the money is actually getting eroded. So investing or saving and saving optimally in a right asset class is very important. And that's why when you're planning, long-term planning is very critical. Also, big goals like retirement, education, things like that cannot be done on short term, right? This requires little longer term planning. If it's a education for children, you need to plan for 8 to 10 years before you can get some decent corpus. In fact, for retirement, you probably need to spend about 30 plus years very early for you to build large enough corpus that can take care of your retirement. So basically, long-term orientation is very, very important before we talk about what kind of asset classes that you buy. So next slide, I want to talk a little bit about how each of these asset classes have done over a period of time, right? So when you look at, this is data, of course, pre the financial crisis that happened in 2008. So you can capture how the equity market or commodity market or, bond markets have done. So if you see here, from 2006 to 2020, at different points of time, different asset classes have done better, right? So that means there have been years where equity has done very well. There have been years when gold has done very well. There have been years when money deposits or debt securities have actually done very well. So it's very important to have that long-term orientation. And more importantly, not just bet on one single asset class, right? You can understand if it's equity, if you have a lot of time, then maybe you have to be a little more higher allocation towards equity. But not having gold in your portfolio, not having debt in your portfolio is very important is very dangerous for you, because there are times when these asset classes have done well, so you need to have that flavor. And it's very important also to see, how do you do this? You do this based on the risk and the goals that you have in mind, your ability to take risks, the tenor of your investments. These things are very, very important. So as I go to the next slide, I want to give you a little bit color about one of the things that mutual funds people think about is mutual fund is very simple. All it needs to do is select a fund and you'll get returns. But the fact is that's the most minimum thing a mutual fund does. The mutual fund is actually a very flexible investment vehicle. It helps you plan much better than anything else that you have seen conventionally. So they can not only, mutual fund can not only help you make investments, but because there are plethora of choice of products in mutual funds, it can actually do well for your financial goals. Things like how can you plan for long term, what kind of risk profile of a mutual fund will help for you. So depending on various investor categories that are there, you have an opportunity to invest in various mutual funds. One other thing that mutual fund does is people, and I have my friend circles, and you also know that each one of us can actually go and buy them very well, right? I can go and buy an equity from an equity market directly and get the benefits out of it. The advantage of that, going through a mutual fund, is not only are you getting a professional fund manager who knows extremely very well about how to manage money and how to invest. Also, you get a bucket of investment. So let's say you buy a diversified equity fund, you get about 30, 40, 50 stocks, which are best in class that's there, at a cost which is relatively very small. When I say at a cost, you probably have to just shell out only 1,000 or 5,000 rupees, but get access to about. So the diversification on your portfolio at a very low entry cost is something mutual funds bring to the table. Also, it is not usually when you say mutual funds, only you talk about stock market, but basically mutual funding, the biggest segment of the mutual fund is actually in the bond market, right? They invest in fixed income securities, in golds, in money market and government bonds. So, and also we have products which are hybrid funds, which basically a mix of equity and fixed income products. So they give you a flavor of moderating your risk while investing in equity and debt. So I talked about how mutual funds are professionally managed. What is also important is there are tremendous flexibility while you're buying a mutual fund. A mutual fund can be done through SIP. I'm going to talk a little bit about it. You can buy a one-time purchase. There are concepts like systematic withdrawal plan. You can invest in a mutual fund, and over a period of time, every month, like you get your dividends or your interest, you can also think about mutual fund as one of them. Obviously, mutual fund returns are not steady. Mutual fund returns keep moving as per their underlying investment, but you have an opportunity to withdraw the money regularly through what is called a systematic withdrawal plan and systematic transfer plan. So basically, that makes it very easy to structure mutual fund. And another thing that I keep hearing about all the time is mutual fund is complicated. I don't know how to invest, right? So, today millions and millions of investors are investing in mutual funds every month, because today it's become very, very easy. Most of this can be done through any of your financial planners or mutual fund distributor, out there, banks. And more importantly, all of these are now available online, right? The entire KYC process to investments in mutual funds can just happen just like that on an online process. So millions of people are today not only investing in mutual funds, but they are coming and opening their mutual fund accounts in just a matter of few minutes. Now, I want to actually talk about how mutual fund helps you in 3 or 4 key category of investing. And I talked about long-term funds before, but I'll give you a little more flavor about how long-term investing mutual fund helps. Similarly, medium-term, and similarly in short-term, right? So what are the long-term goals that you have? Long-term goals are usually retirement, higher education for your children locally, or taking them out of India and making them prepare. Sometimes even savings for a big asset, which could be a house or anything. Sometimes the asset could also be house for a short term. So that definition can vary. So one of the things that is unique to investing in long term is actually a target corpus. Very important for us to understand what does it take to, let's say, retire 20 years from now or 30 years from now to manage your lifestyle. So building that target corpus understanding is very important. And once you understood, usually depending on which age profile you are, if you're a relatively younger age profile, one of the easiest option is, because you have a risk-taking capability and your investment period is longer, you have the ability to invest in equities, or at least have a higher equity in your portfolio to meet those goals, right? So equity mutual funds actually have the potential to give you higher return compared to, let's say, a fixed income or other investment opportunity. But in equity, there is volatility. So you got to stay the course for a longer period of time. And hence, it's equity investing or equity mutual funds are suitable for investors investing for a longer period of time. There are some categories that you will read when you start investing into mutual funds, things like large cap funds, mid cap funds, small cap funds, large and mid cap fund, multi cap funds, equity oriented funds. These are all actually flavors of various mutual fund schemes that are available. And depending on your risk profile, you can pick and choose any of these schemes. Usually the lowest risk products are index and ETF related products, because they just buy a basket and there is no the relatively lower risk. But as you go up the curve and pick, let's say, a small cap fund, the small cap fund invests into small companies, which are obviously have potential to generate higher return, but comes with it with the risk. Another trend that mutual funds have actually been able to give our investors over a period of times are products which are meant for solutions, right? You can create a portfolio by putting many things together, equity, debt, liquid funds, but you can also buy a straight-jacketed products which actually have inbuilt solutions in it. For example, there is a category called children benefit funds. Now, this children benefit funds actually helps you save for your children education month after month for about all the way till 18 years or 20 years, depending on how long you want to save for your children's higher education. So the product itself has that ability to save money every month. And at the end of, let's say, 18 years, when your child goes to 18 years, you have a large corpus for their higher education. Same concept is used in a concept called retirement fund. Now, in a retirement fund also, you can vary your investment depending on what age you are, when are you retiring. But retirement fund also allows you to save short-term or long-term, save regularly to build that long-term corpus for you. So over a period of time, not only have we given choice, but we've also made it simple by getting investors to understand how quickly they can, for a particular cause, there is a particular fund or a particular theme that's available for you to invest in. Now, let's talk a little bit about medium-term investing. And I'm just trying to keep an eye on my time here. I have another 10, 15 minutes on this presentation. So medium-term investing are typically expenses such as buying a house. Sometimes buying a house, depending on the kind of house, could be long-term too. But more like paying your school's fee for next year, or medical expenses, marriage expenses, things like that, which are seen as medium-term goals. These medium-term goals are, as I talked about, up to 5-year kind of goals that are there. Normally, when you have such short-term kind of an investment requirement, you need to think about your asset allocation, the mix of funds that you buy here. Usually, these funds are a mix of equity and debt, because in 5 years, equity still would do well, but there is a risk at the time of maturity, the markets might have not done well. So it's usually wise to look at a mix of equity and debt. We have products, and another great thing about mutual funds, you have products like hybrid mutual funds, which kind of have been designed in such a way that you have an equity and debt. So there is a hybrid mutual fund where you can, there is something called an equity hybrid, where equity is a higher component and debt is a lower component. You have debt hybrid, where debt is a higher component and equity is a lower component. Then you have a category of funds. Again, this is where I think mutual funds shine, where dynamically these categories are managed depending on the market scenario, how the fund manager feels, where the investment should be, either in equity or in fixed income. And of course, gold is also one of the asset category which dynamic asset allocation funds bring. We have another category called equity savings. So one of the great things that mutual fund does is gives you the choice, right? It gives you the choice depending on what tenor, what risk profile that you have. You can pick and choose what kind of product will suit your requirement. Now let's talk a little bit about short-term investing. Now, short-term investing, again, are basically building short-term corpuses like emergency expenses, a travel or a vacation. I hope we all get to do a vacation in coming days, or buying a small asset like a car or a two-wheeler. These are basically short-term goals, right? These short-term goals are anywhere between 1 month to 3 years. So here, I think the orientation is largely towards trying and protecting your capital, but trying to optimize your return. So here we have debt mutual funds, which are usually seen as better than your conventional investment avenues, but also give you some liquidity for you to withdraw the money at any point of time. Some of the category of funds in debt mutual funds are funds like liquid funds, which are as good as a bank deposit because you could withdraw the money in technically 3 days from your invest, and after third day, any day that you want to withdraw, you can withdraw the money. There are category called ultra short-term funds, which are basically investing up to 1 year kind of investment avenue. Also, there are funds which directly invest in government securities. So the principal credit risk is low, but of course, government securities interest rates keep going up and down, and that will have some impact on your portfolio. Then again, we have solution goal-oriented products which are built into mutual funds. So if you are very clear that I have a requirement exactly 3 years from now or 5 years from now, then you can buy what is called as a fixed maturity plan. These funds are basically, they go and buy bonds and securities exactly matching the tenor in which your requirement is, or in the fund's requirement is 3 years exactly from now, and they mature on that particular day and the money is given to you, right? So there are various options available in short-term investing that mutual fund kind of helps you design. So I already talked about the benefits of mutual fund and how mutual funds help, but what kind of gets unnoticed is that the flexibility that the mutual fund kind of offers, right? But the most important thing the mutual fund offers is this concept called systematic investment plan, right? Systematic investment plan has been, there have been a lot of talk about it. People who know this, are big fans of how SIPs work. I myself run a lot of SIPs on different goals. So conceptually, what is a systematic investment? A systematic investment plan is simply put, staggering your investments over a period of time. So let's say I want to invest 12,000 rupees this year. Instead of investing all 12,000 rupees today, I put 1,000 rupees every month, and over a period of 1 year, I would have invested 12,000 rupees. There are many benefits for investing this way rather than putting one lump. So of course, the main benefit is you may not have 12,000 rupees to invest today, but you will have you can invest as low as 500 or even 100 rupees in a systematic investment plan, and then you can continue to invest. One other benefit of investing systematically, and especially through a mutual fund, is that when you're investing in a product like an equity, where you do not know what the market would be a month from now, 2 months from now, today is the right time to invest, or a month from now is the right time to invest, the best concept is what is called as a rupee cost average. So you're investing over a period of time. So that means today markets are low, you have the ability to get more units because mutual funds allot units. And if the markets are high, you get lower units. Similarly, the next installment of your systematic investment plan, kind of averages out, because next month the markets could be lower, you could get more units, or market could be higher, again you could get lower units. So when you think about it, when you invest when you invest for long-term small amounts of money, you are beating the market volatility by spreading your investments over a period of time, right? So especially if you're investing for 10 years, 15 years, 20 years, the volatility is managed superbly by a mutual funds, right? And the beauty of this is that you could do this almost literally every day, because you have options available called daily investments options. Like you can invest 1,000 rupees a day for the next 10 years, or you could invest every week, you could invest every month. Typically, most systematic investment plans are monthly in nature because our savings are also usually tied around monthly in nature, at least for the salaried employees. But that doesn't stop anybody from doing a monthly or a weekly or a daily options. But for those who are tight and who don't have a savings pool which are available every month, you have opportunity to do this quarterly, half yearly, or even yearly. But ideally, today, crores of investors invest in mutual funds through what is called as a monthly systematic investment plan, or an SIP. So one of the beauty of SIP is that it doesn't pinch your pocket. You're keeping aside some expenses that you would have done, and you're going to build a corpus over a period of time. And there are lots and lots of data points that's there, which can talk about how SIPs have helped, create wealth over a period of time. Because one of the, I again talked about it, one of the things is not only does it manage your volatility of your portfolio, but it also helps you in putting out small amounts of money. And that small amount of money is so small that you can do as small as 100 rupees, right? So even the people who are, what we call as unstructured saving investors can also do that. Now, a very innovative concept on SIPs have come up, saying called top-up SIPs. So you can start an SIP of 1,000 rupees today, and in a year from now, your income has gone up. You can actually increase it to 2,000 rupees a month, right? And you can also pause your SIP. One of the things that we saw recently during the pandemic is many people had income issues, right? So they couldn't save more. So this feature called pause SIP says, okay, I don't want to save for the next 6 months because I'm not really sure whether my income is going to be taken care of. So you can actually pause these SIPs, right? And there are, of course, other variants around SIPs which actually help you not just time and average the market, but also gives you the flexibility to increase, decrease, pause your systematic investment plan. But the beauty of this is you continue to invest for a very long period of time, and unknowingly you're building a huge corpus. So one of the great things that mutual funds has done by investing in SIP, by introducing an SIP, is by default. I mean, this is very similar to what you do with your PPF, not just PPF, but your employee provident funds that gets deducted, right? It gets deducted from your salary and gets invested in your EPF or managed funds that are there. You do know that how you're investing, but basically you don't know what's happening till you retire, and you just suddenly see there is a huge amount of money that's available with you. Same thing happens in a systematic investment plan. It doesn't pinch you while you're actually making investment, but on a long period of time, you have a huge benefits. And starting early is the best thing that can happen. The younger you are, starting early in an SIP actually, and for reason rupee cost averaging, or in US they call dollar cost averaging, is known as the eighth wonder of the world. I mean, of course, the quote has been told many times, but the idea is that it's no-brainer. Anybody can do, and SIPs work well. Now, I want to actually end this talk, but before I end this talk, I want to talk about, before anybody jumps in and makes an investment decision saying, hey, mutual funds are great, let me buy that, you also need to understand and educate yourself on the risks that are there in mutual funds, right? And I'm putting out certain risks that's there. As you start understanding mutual fund, one thing is very clear. Volatility in the market also gets captured in mutual funds. For example, if you're buying an equity mutual funds, equity markets are volatile. There is a pandemic here. In the month of March last year, people lost huge money as the pandemic set in. Over a period of time, as people understood that, these things are going to come, we were going to overcome this, market started doing well. Now, if you were one of those investors who wanted money in the month of March, obviously that was not the right time for you to exit. So understanding volatility in mutual fund is very important. Educating yourself that saying, mutual fund investing, especially equity mutual fund investing, has its sets of risk, and the risk can be managed by products like SIP, and more importantly, keeping the investment for a very, very long period of time. So the volatility obviously also comes from concepts like whether the economy is weak, whether the potential companies are potential to do well or not. One other factor when you're investing in global mutual funds, some of them are there, is the currency risk, because obviously currency can go up and down. The last thing that's also important to keep in mind is, while all these risks are there while investing, one of the risks is credit risk, right? The underlying funds that we invest could also go wrong. How does mutual fund manage that? Mutual fund manages this by diversifying. So let's say we put instead of one security or one bond, we buy 20 bonds. Even if one of them don't do very well or don't give you potential return, the return of the remaining 29, 30 bonds would actually give you or average out the return or the loss or lower return on another bond that's there. So diversification on a mutual fund kind of mitigates the risk that's there, and long-term nature of mutual fund mitigates the volatility of investments. But keep in mind, while all these risks are there, one of the key risks that's there is the inflation risk, right? And the inflation risk is the most important risk for all of us to consider. You may continue to invest in traditional investment avenue, absolutely no problem, but traditional investment avenues like deposits or bonds tend to give you return which is usually on a long run just about equal to inflation or lower than inflation. And on top of it, obviously, there is taxes that you pay. Post-tax, most of these returns are usually not optimal. And that's why, managing risk, calculating risk, understanding risk, and then investing in the long run, especially through mutual funds, actually is much more beneficial. So I'm going to stop here, and I can understand that there'll be interesting questions that you may have. So I'm happy to take questions at this point of time. Okay, let me see if I can stop sharing. Ankita, how are we doing this? Are you giving me some questions through chat or? I'm audible, Ankita? Can you hear me?
Hi, Srinivas. Sorry, yes, you are.
Okay. I'm at 6:40. I thought we should take some questions if anyone's interested in asking any questions. One of the, while Ankita is kind of collating any questions that are there, it's important for us to know where do you get more stuff to read about. So you could obviously go to more of these mutual funds websites of various mutual funds, and they have lots of content. There is also a website called mutualfundsahiye.com, and mutualfundsahiye.com has tons and tons of questions around how to invest, where to invest, which are these each mutual fund category that are there, how do you manage and mitigate risks. So most of these are there. And of course, we have hundreds and thousands of our distribution community of distributors who are again available for you to go and consult and make those investments. Some of them are available online, some of them are available offline. Please do talk to them before you make any investment decisions or mutual fund investments. So I see some questions here. Let me just read through the question. What should be the intention before investing? And how much should we consider a good risk if I've just started my career? Very interesting question. It's Mr. Yadav. Okay, so intention of what should be the intention before investing? Intention before investing is to manage a goal, right? I think no investment should be done without actually a goal in mind, right? Otherwise, it's just savings rather than anything. So if you keep a goal in mind, then your intentions are pretty clear. Let's say I have a goal to retire 15, 20 years from now. That's the goal. Now, what are the corpus that I need to make those investments? And what's the right fund or a right asset category that I need to buy to make those investments? That should be the intention of investing. Now, your question is, if you're at the beginning of the career, what's a good risk? I think beginning of the career, I'm assuming you're young, right? I mean, career obviously starts very young. One of the cardinal principle is that you age minus 100 is usually the risk that you take. So if you're in your, let's say, 25, 30 kind of year, 70 to 75% of your portfolio can go towards an equity mutual fund. The remaining could be around debt, fixed income, liquid funds. But of course, that will not necessarily true for everybody. That can change depending on your goal and your other conditions. Mr. Pillay is asking, can you suggest some mutual funds to invest in a period of 3 to 5 years? Now, I'm not here to talk about which mutual funds for you to buy. This is purely an educative initiative. And there are tons of content out there to profile and look at which mutual fund house is better, which scheme is better. But I can tell you, if you're looking at 3 to 5 years as an investment goal, you've got to think about something like a hybrid, kind of fund, equity hybrid or a debt hybrid kind of fund. Those funds are, kind of suitable for a 3 to 5 years kind of a range. You could also buy any of those fixed income funds for that kind of period. Credit, duration, government security funds are good funds to buy. But this would completely depend on your nature of risk and your goal. So I would suggest do a little bit of research around it, talk to people who know, more importantly, tons of content that's available, look up for that and you will get some more answers around that. But I can only talk about what categories kind of suit for this kind of tenor. Mr. Rishabh asks, till when should one remain invested in small cap funds? Oh, that's a very interesting question. So one of the questions which never gets answered is, how long do I make an investment? So there is really no answer for that. The only way to answer that question is you can keep invested, whether it's in small cap fund or a large cap fund, till either your risk profile changes or your goal is met. Right? Of course, you please monitor your portfolio. If your fund is doing very badly, the last thing you want to do is continue in that particular fund. Obviously, you need to reallocate from that particular fund to another fund, but there is really no need to change your asset allocation pattern. If your asset allocation pattern allows you to invest in a small cap fund and you can take that risk, I think you should stay invested till your goal is achieved. Or if you don't have a goal, till you really need the funds, right? That should be the idea. The next question is, why should one consider liquid funds over FD savings? What is the advantage? What is the tax implication? Yeah, it's an interesting question. I think you don't buy mutual fund only for taxation. Of course, taxation is very important and mutual funds kind of optimize tax benefits. One of the underlying things about mutual fund is a collective securities, right? In a money market or a liquid fund, you are investing into short-term securities. Most of the time, short-term securities tend to be better than savings account. Most of the time. Because what is a savings account? Savings account interest rates kind of depend on short-term funds rates in the market. Deposits, on the other hand, can vary depending on the tenor of the deposit. 6 months deposit could be not as good as a money market fund versus, let's say, the 3-year deposit. 3-year deposit could be better. But anyway, if you have a tenor of 3 years to invest, money market or a liquid fund is not the right investment avenue. You should look at bond funds or other funds which can give you better return. So up to 1 year could be a ultra short-term kind of a category. After that could be some bond fund, let's say if you're investing for 3 years. So depending on the tenor of investing, liquid fund will matter. Normally, liquid funds are very efficient for up to 1 year, 6 months up to 1 year. I would say 3 days to 1 year kind of a period. Mr. Robert Robinson says, difference between trade and stock market, which is better for beginners? Oh, interesting question, right? So conceptually, you're still buying the same security. You're buying the stock markets, whether you're trading or whether you're investing. Now, the difference between trading and stock market basically is that in trading, you tend to keep a very, very short-term goal, right? You trade on a stock. But in investing, you take a longer-term goal in mind. So if you're a beginner and you are ready to take the risk in trading, please do. But the risk is very high, right? You tend to, the ability to lose money in a trade is very high, or it's basically speculation, right? You have very limited information, and with whatever limited information you're trying to take a call, especially short-term calls, this can go either way. Investing or buying in a stock market is a better alternative. And the best alternative there is, if you don't want to do much research, if you don't have that capability, either buy an index fund, which could give you an index return, or give it to a good fund manager who can actually manage your money better for a small management fee cost that the fund charges. So everything has its pros and cons. I don't want to say this is good or bad, but for people who have the adrenaline rush, want to play in the market, I mean, sure. I mean, there are people who've made money in the market, but the risk doesn't you need to understand the risk and invest. But for majority of the people out there, that amount of risk is not advisable. So it's good to go and understand your risk and then take which kind of investment decision you want to do. Ideally, the best for most people would be to buy an index fund to start with, or a large cap diversified fund, understand the nuances of how the market works, and then maybe take a call on whether you want to trade or make a long-term investment. Okay, the next question, I don't know who it's from. It says there are certain platforms that promote getting into direct fund without commission, and there are certain platforms that they say they guide better by taking small commission. Which platform should we opt for? Okay, so here is a very interesting question, and this question has been asked many times. So the regulator, SEBI, introduced direct funds very recently. One of the reasons for introducing direct funds are for those investors who can go directly and buy funds from a mutual fund or through a platform. One of the reasons this was introduced is there is a distribution cost that is embedded while you're buying a mutual fund. So let's say a mutual fund charges an expense ratio of 2%. In the 2%, up to 1% or so will go towards distribution, which is the distribution that is paid by the asset management company. Now, if you buy a fund directly, this distribution cost does not apply. But there is a caveat for that. You may say, I'm saving a 1% of by going directly to a mutual fund or a platform. The problem with that is then you get no advice. Then you're at a complete risk of how you have to manage. Then you have to do a whole lot of research on yourself. When things are not well, nobody's there to handhold you, right? Because you're on your own. So it's very difficult to say whether you have to go direct or go through distribution. But if you're a novice investor, I would say go to an expert. For a small cost, he gives you an advice, and that advice will make a lot of sense. Now, some people tend to say that I can do all my research myself. I can look up whatever is available and I can buy myself. So be it. You have the choice of investing directly. But investing directly, while good for your portfolio, may not be very good from a point of view of understanding what you're getting into, choices that you need to make. So I would always say start with understand everything else before you go directly to a mutual fund. Okay, Mr. Anurag again asked me the same question. Can you suggest some mutual funds where I can invest? I'm not here again to talk about what is a good mutual fund. Mutual funds are not stocks. Mutual funds are not speculative. It's not like trying to say go and buy Infosys, SBI, or any of the stock out there. Mutual funds are varied. This will completely depend on your risk profile, what are the underlying stock that are there in the mutual fund. So there is some amount of work that you need to do. Please do that research. And when you do that research, you get to know which category of mutual fund suits you well. Post that, there are tons of resources out there, either through your advisor or through data that's available on the websites, to go and look at what are the good mutual funds for you to buy. But the fundamental principle, once you have identified all of the variables on which fund to buy, the choice that can be made could depend on some historic return the fund has given, the kind of credibility the fund house or the fund brings to the table, the quality of servicing that the fund house has, new concept of how much the fund house costs or the fund costs in terms of management fee that is there. And these are all some of the variables that you need to consider before buying a mutual fund. Mohit actually asked an interesting question. Is mutual fund taxable while withdrawal? Right. So depending on the kind of mutual fund, there are different kinds of taxes. So for example, dividend distribution is kind of taxed. But when you are a long-term investor, when you take out the money after 3 years in certain asset classes, you tend to get capital gains, and those capital gains long term is today tax free. So depending on the nature of the product that you buy, there is a tax free taxability of each of the funds, and there is a whole. I mean, this changes every year depending on how the government or the budget treats each of this category. So look out for that. There is a whole lot of data available on various websites. You will get information on how it's taxed. Generally, it is seen that mutual funds are largely tax efficient because of the nature of which it is there. So while mutual fund per se may not be tax efficient, there are ways to manage your taxes in a mutual fund. So there is that flexibility through systematic transfer plans or long investing for long term. These things are ways to optimize your tax table. Better to talk to a tax consultant or to read up on all the taxations that are available, because I just don't want to go into each category what taxations are, but there is a lot of interesting way to optimize or let's say harness your taxes better than just blindly going and buying funds. Which investment app would you suggest using? I'm not here to talk about which investment apps are good. I would suggest that do a little bit of research. There are hundreds of them today. There's a lot of opportunity for you to go and have a look at and do research. There are funds which AMC's fund houses have their own apps for you to do, but there are also platforms and people who give you plethora of choices that you can make. Do a little bit of research. There are lots of content out there for you to look at, and then you can take those decisions. Mr. Robert Robinson again asks, I think I've seen this question before. Trade and stock market. I think we've gone through this. Okay, Mr. Hitesh Agarwal says, can you guide on few retirement funds which may be suitable with 20-year horizon? Again, I am not here to tell you which retirement fund is good, but one of the principles while choosing a retirement fund. Today, one of the advantages of retirement funds are, initially it was all static funds. Today, retirement funds are coming with choices, right? Some of the choices are, if you are young, you can take a high risk equity, skewed portfolio. And if you are a little more, older, you can take a less equity skewed portfolio. So these flexibilities are today available in retirement funds. You may want to look at some of the offerings that are there before you make an investment. But generally, if you're talking about 20+ year horizon, then some of the funds have, there are different nomenclature for these plans, but usually these plans are aggressive equity plans that are available for you to buy, and that probably will suit you. But again, I would say look up on all this, do a little bit more research before you buy any retirement fund. How do we know the exit time in mutual funds? I think I tried to answer this earlier, Venkatesh. Basically, in mutual funds, there are almost all mutual funds, except for some closed-ended funds, are open-ended in nature. That means you have the ability to invest anytime and you can withdraw anytime, except for some products which have locked in. Usually, these are tax-saving products like ELSS. Most of them are open-ended. Even the solution products are open-ended beyond a particular period. So you can withdraw any day. But I think we should not get into mutual fund by saying, I will buy this because I will take out when things are good, right? Usually mutual fund, the portfolio itself has the ability to exit stocks when they have done well. So how is a mutual fund constructed? I'll give you an example of how a large cap fund is there. A large cap fund has about 30 to 50 stocks in a portfolio. A fund manager then decides which stock to buy, what should be the potential return on this fund, on this particular stock, what is the future of that particular stock. When the stock does very well, if it doubles, let's say in 2 years' time, and it doesn't have a potential to do better going forward, the fund manager does that on your behalf. He sells those stocks and buys something else which has potential. So technically, the profit booking is happening inside the fund itself. You don't need to do the profit booking. What you need to worry about, Venkatesh, is more about whether this goal of yours, which is to invest for 5 years, 10 years, 15 years, depending on the goal, is the goal being met or not? If the goal is not being met, you are not closer to your target goal, then I think it makes sense to continue to investing in mutual funds, because mutual fund per se does all these balancing internally in the fund. Avinash Prabhakar. how frequently and when to rebalance portfolio, and if you have done investments without goal, how do we target goal-based investment? Interesting question. So the modern finance theory says that balancing a portfolio can be done. Usually, you've got to look at it at a longer tenor between 1 year, 3 months to 1 year. But the way to do that is about how far is your portfolio from your goal, right? Let's say, hypothetically, and I will give you a short-term example, then a long-term example. I wanted to save ₹1,00,000 for the next 5 years. And basically, what does it mean? That means that at a particular percentage growth, I am expecting my return to happen. In a period of 3 years, every year, I can then review and say whether it's in line or not in line. Now, lumps and investments are not the best way to look at it, but SIPs are the best way to look at it. In an SIP, these averages are actually managed. The way you balance your portfolio is not necessary only from return expectation. In between, if your risk has changed, for example, you believe that you can't invest anymore in equity, or your requirement of funds have actually come down, then you can actually do some of this balancing on your portfolio. But general principles are every 3 months, you can look at how your portfolio is performing. And every 1 year or so, you can rebalance your portfolio depending on whether it's doing very well or not, or it's going as per your good expectation. Generally, I don't expect nuanced or early investors to look at their portfolio every month or every quarter and say my fund is doing badly, because there are times when funds do badly, but there are times when the fund kind of make up for all the bad things that have happened in the past. So patience usually is good. And to be fair, the best mutual fund and the worst mutual fund, the return differential is usually not very, very large. They're really small. So your choice of bringing the best fund is not necessary only on return, but could be on other things, right? Generally, if you tend to stay invested for at least 1 year and then review a portfolio, that makes sense. And that's why I keep saying self-service is only important if you understand the nuances of it. Usually, it's good to go to somebody who's a good advisor who can look at your portfolio and give you a good advice whether your portfolio is doing well or not. Let me go to the next question. Mr. Monty is asking. Markets minimum 20% key AMC employees compensation to be the news is affected to investors, like expenses ratio may be increased. Please give your suggestions. Well, interesting. I don't plan to comment on. So I think what you're referring to is a new SEBI circular which came out just a couple of days ago, which says that the key personnel, especially fund managers, their compensation up to 20%, at least 20%, needs to be locked into the fund that they manage. Now, conceptually, it's a good thing because what they're saying is skin in the game. That's concept. Now, there are, of course, many nuances and everybody's talking about it. So I'm not going to give a comment on good or bad about it because it'll play out on its own. But I also want to talk about the second part of your question. Will it increase the expenses? No, expenses will not increase. Expenses are fixed by regulations. All expenses of all mutual funds are regulated. Each category of mutual funds have the maximum that they can charge. In fact, in most cases, most funds do not charge maximum. There is also a very interesting thing that the regulator has introduced is the larger the fund becomes, because it has economy of scale, they have to lower the expenses. So we manage funds which are 25,000 crore plus, right? So in such cases, the expenses are even more lower than the fund which is, let's say, 500 crore or 100 crore. Now, what is the advantage of that? Because I have the economies of scale, and the economies of scale advantage is passed on. To be fair, expenses are highly regulated, highly transparent. They are available every time. In fact, every time we change an expense above a particular threshold, we need to write to every investor saying, hey, we are changing these expenses. You have then, of course, a right to either exit the fund because most of these funds are open-ended. So I hope I've answered your question, Mr. Monty. I don't want to talk about the regulatory change that is being proposed, but this should not impact investors' expenses. This should probably impact the fund managers and key personnel in the AMC's portfolios, but definitely not investors. In fact, for investors, there is this now confidence that the fund manager is also supposed to eat what he's making, right? So in most cases they do it, but it's a principle of skin in the game that the regulator is talking about. I'm mindful of time. We're at 7, but there are a couple of more questions that have come, and I'll take those. I just don't understand intraday trading as a career. Are you asking me, is it a career? Intraday trading is a career? I don't know. It's a very incomplete question, but yes, there are traders who are intraday traders, and that's a career that they've chosen. Honestly, it's a skill. It's something that very few people can have expertise. But I don't have to add anything more than that. I'm here to talk about how non-skilled investors can take benefit and how mutual funds get all those non-skilled investors to make money. Abhinav is talking about, I've started SIP 3 months back, but as of now, I'm getting less units as market is high. Should I pause my SIP or continue because I will get less number of units? Abhinav, I think you missed a very important part of what I talked about. Pausing an SIP should only happen if you do not have money to invest. The beauty of SIP is that the SIP averages the market. Market can go high, market can come down. Every month when market goes up or down, you're investing in that market. So you're averaging. In fact, as market goes up, it's good benefit for you because you're investing over a period of time. The day the market comes down, you will average your investment. So on a long tenor, it doesn't matter. Investing through SIPs, investing through, investing every month regularly is probably the best thing to do, because none of us are here to know exactly when the market will go up or market will come down. Timing the market is very difficult. Somebody may say, no, listen, I invested over the last 3 years, but if I'd invested a lump sum, it would have been a great idea rather than doing an SIP. Anecdotally, very few people are able to do that, or are able to at least contemplate and say, this is the best time to invest in the market. SIP is the discipline that's been working for more than a few decades now. People have been investing all over the world through this route, and please stick to that. 3 months SIP, markets are high. I don't think you should even be reviewing your investments. If you're reviewing your investments, maybe after 1 year, you can take a call on it. A couple of more questions. Mr. Tanwar says, should we invest in large cap or multi-cap fund? Okay, so large cap funds are basically investing in the top 100 stocks, right? Usually, right? In the top 100 stocks in the portfolio. That's the definition that's there. These are the blue chip companies, and these blue chip companies are being invested. Now, the multi-cap fund, on the other hand, invests beyond the large cap. They invest in large cap, mid cap, and small cap funds also. What is the advantage of having large cap? Because large cap usually is a representative of what indexes that you see today, which are your PSE 100 or Nifty 50 or any of those broader indices. And multi-cap is a whole market kind of approach where you are buying beyond these visible indices. So the downside of a large cap is that you don't get the flavor of the mid cap and multi-cap, mid cap and small cap. But the advantage of a multi-cap fund is that you get those advantages, but there is a risk involved. As I talked about when I talked about small cap and mid cap funds, these mid cap and small cap categories are highly volatile, but have some gems. And the mid caps of today could be the large caps of tomorrow. So depending on your risk profile, a large cap or a multi-cap will make sense. But prima facie, large cap is a good way to start. And over a period of time, depending on the tenor of your investment, multi-cap would be the next opportunity. But ideally, the risk profile of large cap is less riskier compared to a multi-cap. Okay, I'm just getting the same question by Mr. Ghost Hackers, who's talking about intraday trading. Can there be a career? I think I've answered that. Okay, Mr. JS, I don't know your name. For an NRI who wants to build wealth in India in the long run, 2 decades or more, is there any point in investing debt or hybrid funds? Okay, interesting question, right? I talked about asset allocation sometime ago. Obviously, at different points of time, different assets have done well. And each assets have their own sense of risk. Equity has a different risk, debt has a different risk, gold and money markets have a different risk. So you're talking about 2 decades or more of wealth creation. I would say equity is still a good option when you look like a 2-year, 20 years kind of an investment avenue. So I would say your portfolio should be more equity oriented. Of course, it completely depends on your risk profile. If you cannot stomach the volatility, equity is not a product for you. But generally, on a 2-decade kind of a scenario, equity is a good way to buy. I also talked about not putting all your money in one basket, obviously diversifying, but going for, let's say, an equity hybrid fund if you don't have the high potential to take risk, or investing in equity and then different asset classes in a smaller proportion may be a right investment advice that I can give. But honestly, this needs to be, you've got to look at your risk profile before you make those investment decisions. Okay, I'm getting a lot of questions on trading. I would like to avoid that because I'm not here to talk about equity trading. Yeah, thank you for some of the good words people are talking about. What I've done. Is there any free lessons? Somebody's giving free lessons. Happy to, please, maybe in the group, whoever is interested to, they can go there. Liquid fund, what to look out for? Yeah, I mean, are you asking what are the risks in liquid fund? I think risk in liquid fund is relatively very, very low. However, risk still persists. And in life, everything is risky. In liquid fund is also risky. One risk could be the underlying itself. The underlying, there could be credit event that could create a problem, or the asset management company could go through some liquidity issues. But generally, it has been seen that liquid funds are reasonably risk averse, and especially in the current environment, they are less risk averse, and generally a good investment avenue. Of course, the downside of liquid fund investing is you're not optimizing your return. So if you're looking at liquid fund as a very short-term avenue, I think it's a good idea. It's definitely a better idea than a savings account that's there. Of course, it doesn't give you guaranteed insurance coverage like some of the savings accounts or deposits. I think I have been able to cover most of the questions. Is there anything else that I'm missing, Ankita? What is your view if a financial planner is not charging any fees separately, but managing funds by investing in growth funds and probably take commission at the time of redemption, detrimental to investor? I think I answered this question. I think financial planners are very important. I think they are, they understand and they spend special time on your portfolio. They give you advice on your portfolio. The financial planners, there are 2 varieties. One, of course, is what is called as a registered investment advisors. They are not supposed to take any, they are supposed to sell direct plans and but take, commission or take revenue from you, of course, depending on whether they want to take revenue or not. And then there's another variety of what is called as mutual fund distributor, MFDs. They are actually supposed to give you choices on all the various mutual funds. But I would say consult any one of them if you are very new to this before making any investment, or look up for all the sources that are available on the websites, various websites that are there. Read up on that, and if you are confident, then you can do those direct investing. We are at 7:10. I think we've taken a good amount of time on this. I hope I've been able to answer some of your questions. I hope I've been able to cover all the points that are there when it comes to investing in mutual funds, how mutual funds help you build a short-term, medium-term, and long-term portfolio. Obviously, there is tons to understand, tons to know. There is so much of resources available out there. You should just go and study and get yourself ready. And for people who don't have time or patience, do consult financial planners, do consult mutual fund distributors who can help you do that. I also want to qualify, none of the advice that I gave you should be treated as final advice. Please do take, more research more about what I've already talked about before you take any investment decisions. I wish you all the very best, best of luck, and I hope you create tons of wealth and take care of all your financial goals. Thank you very much.
Thank you so much, Srinivas. I think this was a very, very helpful session, and I'm sure that everybody who watched this is taking away a lot of insights. And like you said, this is guidance, this is insights that come from your experience, and we're glad that we could bring it to everybody today in this session. Um, Thank you so much for joining. Thank you to everybody who joined the session, and we'll be doing these sessions every week. You can subscribe to our YouTube channel and stay updated to learn more about how to manage your money. Thank you.
Thank you, everyone. Goodbye. Stay safe.